Do you ever wonder what are the different types of life insurance policies out there and which one is right for you? Hi, I'm Garrett Ray, financial planner here at the Wealth Guardians and the Ray Financial Group.
And I'm Brice Payne, and you've entered The Vault, the Wealth Guardians video series on all things pertaining to retirement planning. In this episode, we're going to talk about life insurance. The four main types: term life insurance, whole life insurance, universal, and variable. What shouldn't be a variable is whether or not you're clicking on that like and subscribe button down below the screen there. Go ahead and click on that. Make sure you catch all future episodes of The Vault with Doug, Garrett, and myself as we move forward. All right, Garrett, I am so grateful that I won the coin flip on this one, and you're the one that gets to do finally the Vault topic on the different types of life insurance out there. I'm glad this one isn't me. Let's go ahead. Power to you. Let's dive into this. Let's start off with the simplest and most basic kind, term life insurance.
Term life insurance. Let's talk about life insurance, the benefit that people just don't want to think about. This involves your own passing and what various types of life insurance are out there. As Brice mentioned, the most basic kind, the most often used, sometimes people will call this pure life insurance, is called term life insurance. Now, it's in the name. This life insurance policy is going to cover you for a very specific period of time, okay? That could be a set number of years. It could be a 20-year policy. So if you're 42 and you buy a 20-year policy, it's going to cover you until age 62. You can also design them to basically expire by a certain age. Let's say it will cover you up until age 72. So if you had an unfortunate early passing, you pass away before age 72, then your beneficiaries would inherit the death benefit associated with that policy.
Yeah, a lot of times it's maybe not an age, but an event that happens. A mortgage gets paid off, or the kids have graduated college. Your income, should you cease to exist and your income cease to exist, now that need for that income has dissipated or left altogether.
Yeah, Brice, we've seen clients, if they're young professionals, let's say they're in their mid-30s and they have young children, they may design a term life insurance policy that covers up until the youngest child is age 25. At that point, most young adults are out on their own, getting established, and there's no need for, if the parents were to suddenly pass away, a source of funds or a source of income for that likely minor child.
Right. Okay. All right. So that's term life insurance. No cash value to term life insurance.
No cash value. We'll get to that here in a bit. The one thing I will end the term life insurance discussion on is that the death benefit that the beneficiary receives is a tax-free benefit in almost all cases. And normally in almost all cases in a term life insurance policy, the premium that you pay is fixed. You know what it is, whether that's a monthly payment, a quarterly payment, a semi-annual payment, an annual payment, that's going to remain the same for the term of the policy. And the death benefit is fixed. So if you set it at, say, a $100,000 death benefit, it will always remain $100,000 for the term of the policy.
And most people might be familiar with term insurance through their employer group term.
Yep. Absolutely.
That's a common way for you to have access to term insurance at a lesser rate. Credit unions is another way that you could have access to one. All right, let's move on now, getting a little bit more complicated. Whole life.
Whole life insurance. So similar to the term life in that it's going to pay a fixed and known death benefit. Let's say in this case, it's a $500,000 policy, $500,000. But it pays now regardless of the age you pass away. So exactly. We had no term. So previously we had an example of, like, say, 20 years or age 72, or maybe when the youngest child turns 25. That's off the table. This is going to cover you for the entirety of your life. Whether you pass away at age 48 or 88, it's going to cover you. What's the trade-off here? Well, because it's designed to cover the person for their entirety of their life, the premium that you pay is going to be higher than the same amount of death benefit or the same amount of coverage you would get under a term life insurance policy.
Yeah, you can imagine that the insurance company is now taking a bigger risk. It's almost inevitable that they are going to pay out a death benefit in a whole life policy when the insurance company was calculating they probably weren't going to pay out a death benefit in a term. So they can charge you a lesser premium.
Exactly. So the one thing is that, again, now the premium is fixed, but it's going to be fixed at, I think I used the example of, let's say, $70 a month for a term. That's going to be higher, let's say $150 a month for a whole life insurance with the same amount of coverage. The other thing you get inside of a whole life insurance policy is a certain percentage of the premium you pay each and every month is going to go into another account. It's called the cash value associated with the policy. That's going to start at zero, but it accrues with each premium payment that you make. Now, in a whole life insurance policy, a pure whole life insurance policy, that is going to grow at a fixed interest rate. Let's say 3 to 4% annually over the course of your life. Once that cash value accrues to a certain amount of money, you're then allowed to either take a withdrawal of that cash, that's a taxable event in most cases, or you can borrow against or take a loan against the cash value. If it's a loan or you're borrowing against it, that's typically a tax-free transaction there. And these policies tend to be popular for people who they're like any other investor. They have, brokerage accounts. They've got a 401k. They have IRAs. But their goal is that what they leave behind the next generation, whether that's their kids or their grandkids, is going to come majority from the life insurance policy, that death benefit associated with it, because it's covering for them for the entirety of their lives. What does that do for the investor? That frees them up, so to speak, to use their own IRAs, their own 401ks on their own expenses while they're still living. And they're basically part of their estate plan to say, hey, kids, hey, grandkids, when I pass away, don't look for too much in the 401k and the IRA because I would have spent most of that down. Your inheritance is going to come through the whole life insurance policy.
Which is oftentimes a more efficient way. If your goal is a certain legacy for your kids, that's the more efficient way of doing it than, say, putting aside $1 million for each kid and never using it.
Exactly, because remember, the death benefit is tax-free, whereas if you had a traditional IRA that was $1 million where you passed away, now that becomes an inherited IRA, and they're subject to RMDs and all the other stuff. So it's a much more tax efficient legacy and estate planning tool than, say, your 401k or traditional IRA.
Okay.
Yep.
Now, whole life insurance policies are very similar to the next one we're going to discuss.
Yep.
Universal life insurance policies, but some key differences.
Yep. Some key differences. So let's talk about universal life. So very similar to whole life, it's still going to cover you for the entirety of your life. You just have more flexibility within the policy. So in the whole life, you had a defined death benefit, but also the premium you were paying each and every month was fixed. You knew what it was going to be, and in some cases, it can actually grow on you. In the universal life insurance, you have flexibility. The key difference here is that you can adjust the death benefit and you can adjust the premiums you pay each month as financial circumstances change.
Right.
Let's say you started a universal life policy when you were in your mid-40s and you have young children. They're not even adults yet. And you're paying more during those time frames. Well, as you get older, let's say now you find yourself in your early 80s, you've got adult children who are out on their own. They're very successful. You can drop some of the death benefit, which then lowers the premium you have to pay per month. You still are passing something down, but you've just realized that financial circumstances have changed. My kids are mostly on their own 2 feet. They're not going to need too much help when I'm gone. So what this does is that it allows you to lower the premium that you're paying in your later years and freeing up that money that you otherwise would be paying into the life insurance policy for other things. Perhaps your own medical expenses at that time, perhaps an assisted living home, other various means of spending money that you'd rather not go into the life insurance policy.
Yeah, Garrett, one question that we get when somebody sits down with us is they hand us their most recent statement of some kind of insurance policy that they've had for a while and say, should I keep making the premium payments in this? Well, that's one question to answer, but it might be a more complicated answer. And it's not just yes or no, you keep making the payments or you stop making the payments, but do we alter how much we're paying into it as well? That's another type of question to ask. And it's oftentimes the answer. It's like, we don't want to keep paying this much, but let's pay a lesser amount until X happens, the mortgage is paid.
Yeah. And if someone has a universal life insurance policy and then we say, okay, it's got a $500,000 or $500,000 death benefit. Hey, Mr. and Mrs. Smith, do you believe that your children still need that $500,000 if you were to put
deserve it?
Or deserve it. That happens too. If you were to pass next week, does that still fit the bill? It may not. And that helps answer that question. Should I keep paying into this?
Okay. So now we're going to get to the last one. The first three, term, whole, and universal, all had one thing in common. The benefits were all defined.
Yep.
There was no ambiguity in what you were going to get if you passed away, or what the face value was going to be, what cash value would be, et cetera. Enter the word variable, because now we've got variable life insurance. And whenever we have the word variable in any kind of investment, that means that it's variable.
Something's got to change.
Something's going to change, and it is not defined, right?
Yep. So let's talk about the variable life insurance policy. So in most variable life insurance policies, the death benefit is actually fixed. They can change them on you, but for the most part, you're going to know what that death benefit is. The kicker here is that the amount of accrual in the cash value associated with the policy is tied to investments that are inside of the market. Typically, that's most often mutual funds. It looks kind of a lot like your 401k plan, where you've got, a list of maybe 10 to 15 mutual funds you can invest in. Same thing's going to be true of this insurance company. They're going to give you a select list of mutual funds you can invest in. But those investments basically are the value of the cash value inside the policy.
Okay.
Additional limitations inside the variable life insurance policy: you may be required to keep a minimum balance inside that account. More than likely, you're also going to be charged the fees associated with the management of the mutual funds, the expense ratio of the mutual funds. Those fees will be deducted from the cash value inside the account. The issue we run into sometimes with the variable life insurance policy is that the cash value generally has greater growth potential than, say, a whole life insurance policy, where it's at a fixed interest rate, 3 to 4%. It's nothing spectacular to write home to. You've got a lot more growth potential inside the variable life insurance on that cash value. The problem is, of course, it's tied to the market. So if you happen to pass away at a time when the markets are down, that cash value could either be down, or you could actually have a loss inside of that account. And a lot of variable policies allow the beneficiary to inherit not only the death benefit, but they may be able to inherit the cash value associated with the policy. But if part of your legacy planning or your estate planning is, hey, I've got these investments that are tied up in this variable life insurance policy, and you pass away during a market downturn, the amount you leave behind could be a lot less than you were anticipating. So that's one of the trade-offs within the variable life insurance policy: greater growth potential, but of course,
some risk
at market risk.
Right.
Yep.
Yeah, anytime you hear the word variable in the insurance world, it's going to mean exactly that. Potential for more growth, but also you're taking on some risk, whereas in term, whole, and universal, you are taking on no risk.
Absolutely.
Yeah.
So, Brice, hopefully in the past 10 minutes or so, we educated the listeners on the four main types of life insurance out there. There are derivations of all of these, but this will give you a working understanding of the four main types.
Very good. All right. Well, thank you again, Garrett, for being brave enough to tackle this this Vault episode, and thank you everybody out there for tuning into this episode of the Vault. Once again, like and subscribe buttons down below the screen there. Go ahead and click on those if you want to catch future episodes of the Vault. As for now, I'm Brice Payne.
And I'm Garrett Ray.
And this has been The Vault. Hey, it's Brice Payne with the Wealth Guardians. Thanks for watching our weekly series, The Vault. Do you know we also have a weekly radio show where we discuss all things retirement? You can listen to the Wealth Guardians radio show live on 94.5 WPTI in the Triad on Saturday mornings. But if you miss the live broadcast, you can also catch it on our YouTube channel or find us on your favorite podcast platform each Saturday morning. Make sure to subscribe wherever you listen so you can get notifications when we release new episodes. Want you to remember, good retirement plans do not create themselves. We'll talk to you soon.